Hello, and welcome to Russell Investments Market Week in Review for the week ending March 22nd, 2024. I'm your host, Zoe Wargans, and today I am joined by Olga Bezrikov, a senior portfolio manager here at Russell Investments. It's great to see you, Olga.
So good to see you as well, Zoe. Thank you for having me.
Of course, anytime. So there has been plenty of news this week from central banks around the world. Let's take a trip around the globe and start with Asia and the historic moves by the Bank of Japan.
Yeah, sounds good. So, as widely expected, the Bank of Japan exited negative interest rates with their first hike in 17 years. With this, the BOJ abandoned the curve control, which was the policy that they established in 2016 of intervening with bond purchases to ensure that the yield on the 10-year Japanese government bond would not exceed 1%. Now, despite the hike, Japan still has the lowest policy rate in the world, and the expectations are that this will not be a start of a new hiking cycle. So, this is more likely to be a one and done hike for now. This is in large part due to the commentary from the central bank, which included the commitment to accommodative monetary policy given their outlook for economy and inflation at this time.
All right, so rates hiked in Japan, but that is not the case in Europe, correct?
That is right. On one hand, we had the Bank of England, which held rates steady at their 16-year high. Notably, this decision point is the first time since September 2021 that there were no votes to increase rates, signaling a shift in the perspective of the committee. While the governor, Andrew Bailey, was cautious in his comments that they are not yet at a point where they can cut interest rates, the committee indicated that the policy could still remain restrictive even after some rate cuts were in place, which would continue to support their efforts to keep inflation near its 2% target. With inflation reading coming in lower than expected this week and Bailey's comments, investors increased their bets that the BOE will cut sooner than previously thought. That said, domestic inflation in UK remains persistent and came in at over 3% in February, which is still above their target. All of this means that while the Bank of England may have room to cut rates later this year, the timing still remains uncertain. Now, also, in a bit of a surprise to the markets, the Swiss National Bank cut rates, becoming the first among the world's 10 most traded currency to reduce rates since the interest rate hiking cycle has started. The SNB had the room to move because Swiss inflation has been significantly weaker than expected, coming in below the 2% for some months, and with expectations that it will remain so over the next few years.
Very nice. All right, so a little bit of everything so far. Yeah. So let's come on back home to North America. What do you make of the Fed's most recent moves, or lack thereof?
Yes. On one hand, no changes in US central bank policy as the Federal Reserve left rates unchanged on Wednesday, as pretty much everybody expected. Now, heading into the meeting, investors were thinking of Fed's interpretation of trajectory for inflation in the US, as we saw some signs that it may be stickier than expected previously. The market participants were also very focused on the dot plot as the most interesting outcome of this March meeting. The dot plot is the chart that plots each Fed's official forecast for short-term interest rates, which is updated every 3 months and can provide some insight into potential future rate decisions. Now, expectations heading into the meeting were for the Fed to pencil in 3 cuts for 2024 with a likely start in June. And the markets largely got what they were looking for. Both growth and inflation forecasts from the Fed have been raised, though pretty modestly, while the unemployment forecast has been lowered. All of that is reflecting a continued strength in the economy. With the slight tick up in expected inflation, the Fed is currently pricing in 3 rate cuts for 2024, though we should know that nearly half of the Fed officials do prefer 2 or fewer rate cuts for this year, so more data is definitely needed. And on that front, while Powell continues to be data dependent and cautious with respect to the timing of this first rate cut, he did not seem overly concerned with the recent uptick in inflation, saying that it was still likely that they will achieve confidence in getting to their target and that there will be rate cuts later this year. And for more on our views, do be lookout on for the global market outlook that will be released next week.
Awesome. Thank you, Olga. That is a lot to take in, and that global market outlook should also help us a lot just trying to parse all of this information. But for now, how do you think the market is reacting to this sort of mixed bag around the world?
Definitely. So, in the wake of all of the central bank action or no action in a few cases, optimism around higher projected growth and continued expectation of three rate cuts for the Fed for 2024 has been very positive. Both equities and bonds rallied. The S&P 500 hit a new record, and Treasury yields have come down a bit from the recent highs. So far the markets are responding favorably to the Fed's actions or inactions.
Great. Well, it's really nice to be able to end this conversation on a positive note. Thank you so much, Olga, for joining us and helping us wade through all of this information. It's always a pleasure to see you. And thanks to all of you for joining us. Please tune in next week for Russell Investments Market Week in Review.
Hi, I'm Sophie Antel-Gibert, Head of Portfolio and Business Consulting at Russell Investments. If you liked what you just saw and heard, consider subscribing to our YouTube channel or check us out on LinkedIn. Thanks for tuning in.